Hey guys, I'm Josh Finlay,
I'm Aaron Laycock.
and this is the Build Financial Podcast. Today's episode, we have and are sitting down with Kunj Patel. Kunj works for First Source Capital. If you guys have been listening to all of Aaron and I's content over the last little bit, we talk a ton about construction, financing, the missing middle. And in today's episode, we get to chat with Kunj about how that works and what he does.
Yeah, First Source is a construction lender that we use fairly often. They definitely have products geared towards, what is this like missing middle conversation that's going on. So, everything under, basically 2 million up to 10 million. They do some larger stuff as well too, depending on borrower covenant and whatnot. They've got a great program. They have a great grasp on their underwriting and how they're structuring, and can get quite competitive with the loan to values and structuring there. So again, if you're looking for an alternative, financing source in the construction, opposed to going directly into CMHC, First Source and these private lenders in general are going to be a great option for the middle level financing on these construction projects.
Yeah, we dive pretty deep into how all these lenders look at your project, why you should use them in today's market, and what they're looking for to be able to approve your loan. Looking forward to having you guys on. And we are live. Okay. Everybody, thanks for joining today. We are actually super excited to have Kunj from First Source in today. Thanks for coming. We appreciate it.
Thanks for having me.
Yeah, I know. We're really excited about this. Construction has been a massive part of the transition for mid-size investors. There's a lot of questions around the capital, how the debt works right now. So we wanted to dig deeper into what that market looks like, what people can expect when they're looking to apply for it. We're going to touch a little bit on CMHC financing, how it's impacted your business. But before we get into all of that, why don't you tell our listeners a little bit about you?
Yeah, so my name's Kunj Patel. I'm AVP at First Source Mortgage Corporation. We're a boutique mortgage lender that lends across Ontario, like generally going from London to Ottawa, down to the Niagara area, and then up to sort of Barrie, lending to a lot of mid-sized developers that are looking to build, let's say, two triplexes or like a 10 or 20 unit townhouse development. We also do a lot of industrial bridge financing or other income-producing bridge financing today. Not touching land today, so I mean we'll come back to that later in the podcast, I guess. But yeah, that's generally what we do, like working with a lot of mid-sized developers in Ontario.
Yeah, I'm assuming that business is busy.
Oh yeah, there's no shortage of requirement for capital in Ontario and Canada. I think we have so few lenders here compared to the States, and the big boys like the big six or the larger financial institutions, they're busy with larger builders, and so we have to fill that gap for small and medium-sized builders that can't access that capital. So yeah, it's always busy.
Yeah, we were just talking about that on the last one we just shot, just in terms of accessibility. I mean, the big banks, like, they're not even looking at stuff under 20 million. I mean, maybe if you got a personal relationship with them, maybe 15, but I mean, 15 and above, there's not, in that mid-level, there's not a whole lot of guys transacting at that loan size. That's not even like budget size. That's like your mortgage amount has to be like, 15, 20 million. Then, even getting into like the CMLSs and the First Nationals, like even they have loan size caps as to what they really want to entertain. And when you're getting into the construction side, 98% of the lenders don't want to lend on construction under $10 million, right? And that really puts a lot of pressure and a lot of distress on the mid-level guys that are building these, 8 to 12 unit building, 8 to 12, like 20 units, 8 to 12 specifically. I mean, you're probably $2.5 to $4 million, $2.5 to $5 million in loan size for the most part, which, when you get into CMHC construction financing, even further, there's even less guys that lend, not even sub 10, but even like sub 5 million is, there's like one or two guys that I can think of that are really doing that. And that's where you guys come in like the semi-private financial institution debt. You guys are like really that missing piece there for the missing middle financing.
Yes.
Yeah.
Okay.
Yeah. No, we've had a lot of success doing that recently. Actually, it's like we've carved out a great niche doing that. Just like you said, I think the margins on some of this CMHC stuff is a lot lower. So larger institutions definitely want to be doing it in more volume. But we charge a little bit more in our space, but we're able to provide and sort of fill that gap that needs to be filled.
Well, I think it's just a common misconception that there's a ton of options out there. And as we moved into like a higher interest rate environment, conventional financing options, which most people, could have went to their local credit union and tried to get their financing at 70% loan to cost, you're still underwriting the takeout at the back end of their underwriting for the project. So, as soon as interest rates went up and the debt servicing didn't work at the back end, everybody had to flip to CMHC as a viable exit. And the majority of the credit unions aren't set up to be able to have that as an exit. So, none of the loans were working on the conventional side, which inevitably was just pushing people into the private space. And which obviously why, we're trying to fund this missing middle here, and why we push towards using a MIC to be able to get these projects done, because most clients at the moment would rather have a slightly higher cost on carrying and getting the project done than having a ton of equity in the file right now. Are you guys seeing this?
Yeah. The other issue is also just timing, right? Like, yes, you could potentially go to CMHC and get your financing there, but it's going to take you a lot longer than it is with us. So even if our rate and fees are a few points higher, I mean, if you consider the cost to carry for another 6 months or so while you arrange that financing, it almost works out to be the same. Like, it's better to build it with us, pay a little bit more, stabilize with market rents, and then get your exit financing, right?
Yeah, and I mean, like in today, so I mean, as of like essentially end of August, like if you're looking to finance construction by the end of the year, like it's not happening with CMHC. Like, you're not getting any shovels in the ground, this year. If you're trying to get that project started, it's not happening. So, for you guys to be able to fund something, maybe 6 weeks on a good timeline, right? If you have everything ready to go, six, maybe 8 weeks. But I mean, even that, 2 months to getting like actual shovels in the ground, not just 2 months to get a COI and then another 30 days to fund with that. But like the timelines are huge to be able to turn that around, because especially on some of the bigger projects, more expensive piece of land, more expensive residential assets, if you're holding any sort of like debt on there, you're paying interest for every day that you're waiting to get that that acquisition financing taken out if they didn't do it directly with you guys. And it's money every day that you're not actually moving ahead on your project is capital. And especially in today's interest rate environment and how things are moving, people kind of want to get in and out of these projects as fast as they can to be able to get into that cheaper term debt and just start making money on the project and get out of the red.
Yeah, and even in terms of draws, like, we're a small organization. There's less layers of approvals you need to go through to get your draws. So I don't know how long. Like, you guys can probably chime in here, but how long does it take a builder to get their draw when they submit construction financing? I don't know.
It could be weeks. Yeah. It could be weeks. It's funny how we've had clients who have used you guys and who have draws almost instantaneously, 24, 48 hours after they get their sign off from the GC, and then you have them flip to like a conventional lender, and it's just like the world is ending because they have this expectation that everybody just gives them the money instantaneously, and you're like, no, this is actually, you were pampered. You obviously paid for it, but like,
yeah,
you are now understanding the advantages of getting to take a mortgage investment corporation financing. The draws are extremely flexible. For anybody who doesn't know, the reason why somebody would really go to a MIC is a few reasons. One being less liquidity required in regards to equity. You're able to take on a little bit more debt than a normal bank would. Your takeout financing options, you can underwrite based off of CMHC, and your takeout financing makes sense as long as you have a strong business case, and the flexibility around the actual product itself. You can some allow for many draws, some allow for quick capital coming back to you. The flexibility around maybe using maybe not one of the big boys like Altus for a QS. There's a lot of advantages of taking this type of debt, especially when you're looking to grow from building a fiveplex to like maybe like a 15 or 20 unit building. Like, this is where the experience comes from. The whole chicken and egg situation where the bank isn't going to give you the money because you're not the guy.
Yeah.
Well, this is how you become the guy. And unfortunately, people don't realize you have to take these steps, and there's different types of capital in the market to help you get there. And it's not necessarily a bad thing, but this is how you truly get to where you have to go.
Yeah, you got to build your portfolio up, right?
Yeah.
Like in any other business. Yeah.
Yeah, and in today's world, like with how few solid contractors there are out there right now, and with how difficult it is to get them onto your site and on your job, if you're waiting, 2-3 weeks sometimes for financing or for that tranche to come back in, those guys might be on another job doing something on the interim. And then, if they're getting paid on another job site, they're going to have a hard time kind of getting them off that and back on your own job. So, that 2-week tranche might turn into a 3 or 4 week wait period, because now you're waiting for them to get back off that other job and back onto your own, or, they got to get back into the groove of things or something like that. So, I mean, it's, again, like in the higher interest rate environments that we're in right now, even though we're slowly kind of coming out of it, the faster you can get that project done, the quicker, or I guess like the more you can keep your guys on site and actually keep them working and moving forwards, that's going to help your project. I mean, you could shave off, like a month or two of your construction time just by waiting on tranche times.
Yeah.
Right?
Yeah, for sure. And that's interest carry, right?
Yeah.
So time is money.
Absolutely. And I don't think you truly understand it until you get through your first one and you're like, oh, well, 3 months of carrying costs at $2 million. You start to crunch the numbers. You're like, that's a significant amount of capital, but we try to get a large enough IR to be able to make the numbers work. Let's get into something that, a lot of the developers or people who are looking to get into development have to do at the start. They have to buy land. Now, if you're a broker, I mean, if you guys work in the debt markets, mm-hmm. I see land that has astronomical numbers on it. It's a $100 million piece of land in Mississauga. How are lenders looking at land at the moment as of right now?
I think lenders aren't looking at land, frankly. I think taps are off on land financing today. And so that makes it difficult for anybody that's looking to acquire land and get debt on it. Yeah, we've seen, appraisals that, like you said, show huge numbers that we just can't justify today. The problem is today, like, there aren't a lot of trades happening in the market, mm-hmm. and it's very difficult to nail down exactly what land values are, especially when, you have the resale market and new home construction market also hitting sort of it's been a blockage. Like there's no transactions happening. So
yeah, I mean I've tried to get land financing done multiple times over the last 6 months, and if there are pools of capital out there that are doing it, the cost of that debt and the loan to value are completely different than where we were at 2 or 3 years ago. So just setting realistic expectations as to land financing right now. If you are looking to get into a development, realistically, like most lenders aren't going to give you the capital. Your equity injected up front is going to have to happen on the acquisition of the land. And then, it obviously makes things easier when you're looking to finance the hard costs of your projects as well.
Yeah. Lenders will recognize that when you move to construction. But yeah, like you said, nobody's, I wouldn't say nobody, but there's most lenders are not financing land today.
Yeah. I mean, and it's, especially if you take a look at where the majority of projects are happening, maybe from the GTA, land is a bit easier to get done. But outside the GTA, where I'd say probably the majority of projects are actually happening, the risk is just huge. Land's expensive. You're probably 11-12% first position on land, maybe 50% loan to value, mm-hmm. if you're lucky and it's a good piece of land. And that's land that's probably ready to go. If you just got like brownfill, non-zone land, like, it can be difficult to get financing on there because the lenders want to know what's your exit, how quickly you're going to be out, or do you even have an experience? If it's your first project and you're not experienced with getting approvals and transitioning into construction financing, it's going to be even more difficult for you to get financing on that land. Like you're probably going in cash, which again isn't the worst at the end of the day because it is equity towards your equity position and it's going to cut in your carrying costs. But I think the big issue for a lot of mid-sized guys is just liquidity is on the tighter side and they don't necessarily have as much capital to be able to put down, free and clear land or property, whatever it is, and then also come in and go through the soft cost permits and stuff like that. And having to wait until that first tranche to be able to get a little bit of that equity back, it is more difficult. But that's the risk reward of construction financing. It's a higher capital requirement, but the upside is much higher if you're able to get the project done.
Yeah, for sure.
Yeah, absolutely. to say challenging, is an understatement, but we are seeing a massive shift from the retail investor who, purchased a bunch of duplexes and triplexes and fourplexes, and they're getting out of that space. They're getting into either small multifamily, mid-sized multifamily, or they're building purpose-built multifamily. And as the multiple conversations we've had, nothing pencils. You're building spec to sell. So everybody's transitioning to building these small, mid-sized multifamily projects, and they are looking for this construction debt. So like from your perspective, I'm sure you're seeing a lot of this. Like, what are you guys seeing with that space? Like, obviously you have borrowers who have never done this before, but they probably have some experience in purchasing real estate. Like, how are you guys looking at these clients, and how are you being like, okay, well, this makes sense, or like this is bite sizable? Like, what are you guys seeing?
Yeah, so I mean, ideally we want to see some experience from the team, but if that's not there, then the key is really that they've surrounded themselves with really experienced people, or somebody that has a piece of the project that's got a lot of experience. So maybe the general contractor, if they've done a lot of developments and they're interested in partnering up with these guys that have capital and they're going to be building it, and they've built other stuff before that, and sort of that makes sense. So we want to see some experience for sure. But yeah, like you said, we're seeing a lot of smaller guys sort of transition into 8 to 12 units, multiplexes, and it's really driven by the environment today and the financing offerings, which is CMHC, right? It's the only stuff that really pencils today. So everyone's sort of shifted to doing rentals because you're not able to get any sales done today. So that's where the market is today.
Yeah, I think something else that we kind of see too is also just like the discretionary underwriting from a lender standpoint versus just, taking an appraisal at full face value along with the performer, right? I mean, I know a lot of questions that we kind of get specifically more on either going directly into CMHC or transitioning into CMHC, but looking at, like a cost per door, or how much are you guys taking a look at the rents on a performer and the given values? Like, again, like how much are you guys taking the appraisals at face value versus how much of your own underwriting are you kind of doing? And like, what are some of the key metrics that you guys are looking at? Are you focusing on like a cost per door for the construction? Are you focusing on where those market rents are coming in at? How are you guys?
Yeah, so we really underwrite to the exit, and the exit is largely driven by debt service and loan to value, but I think more so debt service. And so the rents that you're underwriting to are very key. So we do a lot of due diligence, oftentimes engaging realtors or, looking up online on various platforms, whether it be Kijiji or Realtor or Altus or wherever, to check that, the rents provided in the appraisal, those are actual rents that are attainable, because that'll ultimately drive the value of the property. And then we may use a slightly more conservative cap rate as well. So yeah, we're really looking to underwrite to exit, and then further to that, we have certain ratios that we're also looking to maintain, right? So loan to value, we probably want to be about 65 to 70% on the as complete value, and loan to cost, including everything, including sort of your land, hard, soft, interest, carry, everything, like you're probably around 85% loan to cost. So we want to see some equity into the project, around 15 to 20% equity from the borrower.
Yeah, upfront for sure.
Yeah.
Yeah, I mean, when you're looking at the transition between the type of investor that is moving into this space now, obviously everything is different. The way in which you get financing is different. Like, you're moving in and out of different types of capital. And we're seeing just the need for people to have to understand how this works is becoming more evident every single day. So, obviously this podcast is the reason why, we're doing this. We've shot a ton of content around, helping investors and just the Canadian population in general do this. But we truly believe that this is where, investment is going. I think that, as you guys probably know, a lot of the big guys aren't penciling hundreds of units in purpose-built multifamily. It's not happening right now.
Right.
They're not taking their condo projects and turning them into purpose-built rentals. But the guys who are going to transact, and who are probably going to transact for the next few years, are going to be these mid-level mid-tier people who are going to try to strategically use you guys, to use credit unions, hopefully when rates come down, and CMHC, kind of like the trifecta of debt that's being used right now or utilized to purchase the stuff.
Yeah, we've actually seen a couple of our builders. They were looking to do condo projects in the St. Catharines and Niagara region, and like a few of those guys have actually transitioned from doing a condo project, and they're changing it over to a rental project today, because that's what works and that's where the financing is, right? So especially with CMHC, where you can get your 40, 50-year amortization and those low rates on the takeout, and to make a debt service and get the exit, that's really the key. So we've seen a bunch of those being transitioned over to rentals. But like you said, they're anywhere between, I don't know, 10 to 50 units, right?
Well, if you have debt on the dirt and you're burning capital waiting for a market to come back, it's a bet, right? You might as well do it, especially if we can absorb it. And I think we can. Our previous guest was actually just talking about the softening in rents across the board in most major areas right now. We're seeing a decent shift in softening in rents. When you guys are underwriting your stuff, obviously an appraiser is going to give us a projection of where tomorrow's rents are going to be. Are you guys like taking off a certain percentage of your EGI here on the takeout?
We underwrite to today's rents.
Gotcha.
So it's very difficult to project out into the future. So we underwrite to today's rents, today's costs, construction costs, and then build a budget based on that and an exit based on that. So, I mean, over the last few years, we've definitely seen rents skyrocket. We obviously have a bit more of a buffer than others, just given that we're some private financing. Like generally, our borrowers, when they go to get their exit financing, they're getting a lot more money out than what we've provided with them in order to complete the project. So it's all right. There is a bit of a contingency there, but to answer your question, we're really underwriting to today's rents and today's costs, and it's very difficult to predict the future, right?
Extremely.
Yeah. Which is good, because I mean, like, it's difficult enough to achieve, like strong structured financing on the construction side as it is. If we were trying to budget in like futures values of, materials and cost of labor and, where rents are going to go. I think that we'd create a bit more of a whirlwind than what we really need on the construction side right now with how short we are on units. So it's probably good.
On the construction side, like sometimes we build in escalation contingencies as well. We saw that through COVID where, construction costs are going up so rapidly that when we were looking to do construction, we were building in 10 to 15% escalation contingencies. But I think construction costs have really stabilized right now, but who knows, right?
Yeah, as these projects finish too, I think that labor will also come down to meet the requirements of where the market's going to be at. We were actually having dinner yesterday, I think it was, with somebody who was talking about how just the condo market in the GTA is giving him anxiety, to say the least. I think it's going to be interesting to watch how this trickles into construction debt in general. I mean, I'm sure everybody's got exposure. Everyone who's playing the game has exposure in this market. What are you guys seeing kind of from the inside based off of, all these construction lenders who have exposure to these developers in the GTA?
We're a mid-sized player, so we don't have, $100 million or $200 million construction condo projects going for us. Like most of the stuff that we do is, I'd say it's in smaller markets, generally in the outskirts of the GTA or outside of the GTA, and let's say Kitchener or Kingston or Barrie, like markets like those. And we finance like 10 to 40 unit builds. So, luckily we've been all right so far, financing those. And really because when we started doing construction financing a couple of years ago, we've had a heavy focus on doing rental developments. So rental developments today are fine. And, the other projects where we had some pre-sold townhouses, and we've seen, some purchasers unable to close, but generally we've been all right so far.
Good to hear.
Yeah. Are you guys seeing, because I know like from our end, from conversation, like there's the mid-sized guys that are, I'm going to build up my 20 units, but I'm going to do it as like a condominium because, 5 years down the road or 10 years down the road, maybe I want to turn around and sell these when market affordability comes back up. Like, when you guys are having more, I guess, direct conversations with guys, like, are you seeing that as like a popular trend? Are you having more and more of those conversations where that's kind of a thought further down the road as an exit, or
Like they're gonna build it as a rental today and then change it into a condo down the road.
yeah,
I've heard it from a couple of guys, but we haven't really done that. Like I think every project that we've sort of got involved in, it's being built as a rental. It's meant to be a rental, and they either plan to hold it for the long term or sell it off to a multi-residential REIT at the end of it.
yeah.
Yeah.
Yeah, I mean, policy rate decisions right now have kind of fundamentally changed with the increased densification, both from a federal level and from like a municipal level. In the GTA specifically, we're seeing that 4+ ADU construction project. People are using construction financing to be able to build these things and then restructure them out with CMHC. Are you guys seeing people try to do that right now?
We're seeing, I guess I think we even have a project or two with you maybe, where, somebody buys a detached home, breaks it down and builds like a fourplex on it. Right. So yeah, I think people are taking advantage of it, but there's such a shortage of housing that's probably not going to be the ultimate solution, but it definitely helps, like add to the supply of rental inventory.
And I think, like I think that's definitely what I'm seeing the most popular amount of are like these infill projects where they're buying pre-existing single family home, especially in some of these areas where the lots are so deep. Like if you have a lot that's 220 feet deep, like you can sever that. You're building side by side fourplexes. You're able to get sometimes even further zoning amendments, getting additional basement units in there, and getting 10 to 12 units on these two lots. And if you're able to have a strong enough planner and have strong enough relationships with the city and getting things done, like you can really stretch these projects out and really turn them into like strong cash flowing assets. I think like a common question that a lot of investors kind of ask, or maybe they don't fully understand is with from a lender standpoint, if they're tearing down that asset that's already on there, you guys and most lenders look at that as essentially a land loan, right? You're essentially considering the fact that building is not going to be there. We're not really going to give true value to it. It's kind of a land play. So from a borrower standpoint, because it's so difficult to kind of get that acquisition financing before all the approvals and stuff are in place, if they're not closing on it as part of the actual construction loan, maybe just kind of explain to them like how you guys take a look at the takeout financing. So if they're using separate acquisition financing and then they're coming into you guys for the construction loan, obviously we have to kind of take that out. How do you guys look at that? Like what do you kind of typically see as how you're structuring it? Maybe just kind of break that down for them, because that's something I get a lot.
Okay. So I mean, if there's an existing mortgage on the property where, you definitely have to pay that out, because First Source, we only do first mortgages. So we don't do any seconds. We're purely a first mortgage lender. Although we can partner up with larger institutions to do AB structures on larger deals. Like if we're doing stuff that's $10 to $20 million plus, we'll generally partner up. We have some good institutional relationships to do that, to bring in capital. But I mean, somebody that's bringing us let's say a detached home that they've got a mortgage on, they're going to tear it down. Like you said, we're not allocating any value to that detached home that's there right now. We're looking at it as land, and then plus the build, and then see what the final value at exit's going to be for the completed construction project, right? So you do have to pay out the existing mortgage, whatever it is. So generally, it's just a plug between the loan amount that we give you and the cash required to complete the project, plus pay out the existing mortgage. Yeah.
Which is roughly what, 20% of total project cost?
Yeah,
Essentially.
you're about 20%. So if total costs, like we said before, loan to cost around 80 to 85%. So you're looking at 15 to 20% cash equity that's got to go into the project to make it work.
Yes, for everybody who's crunching numbers real quick, that's 200,000 for every million. Your average construction financing project is 4 million. You're $800,000 in cash equity injected to make these numbers work. You need to be able to have either the equity or the cash to be able to inject first to get the project off the ground. I know CMHC changed some rules recently where we can no longer apply to CMHC construction financing if there's any piece of the structure of the pre-existing structure on the site. Residentially, yeah.
Really?
So if you want to build the zoning allows for it, you want to build a 10-plex, you don't have to go through SPA anymore. It's a house on it. We can no longer submit to CMHC if there's a house on it. You have to demolish it first. CMHC will not allow for us to factor in the demolition cost of the house. And then we have to wait the 6 months to be able to get the COI to be able to move things along. So they've essentially just killed all mid-sized development with a pre-existing property on it.
Yeah, so that's where a private lender like ourselves really can come in, because we'll recognize that the builder, they've got to pay money to tear down that house, but we'll look at the land value and the total cost to build, and like you said, instead of waiting 6 months, let's get an approval in place and fund this thing in 2 months and get the construction going, right?
Well, the kicker is you have to pay for the property in cash to be able to knock the house down. No one's gonna, Scotiabank's gonna be real upset with you. You knock the house down. So it no longer makes sense for these mid-sized projects and mid-sized infill projects anymore to go direct to CMHC if you don't have a significant amount of cash to sit there and park and wait to then submit the file. So this is where you guys come in, or where alternative financing options come in, with rates still being where they're at with the credit unions. It doesn't make sense. From a takeout financing or equity injection perspective, it makes sense to expedite your project and to move forward with, creativity and speed in this case.
Yeah, for sure.
Maybe chat too, on, in terms of as improved or highest and best case, values, do you guys have certain timelines that you will consider an increase in the value on the land based on what they purchased it for? So if someone buys, a piece of property for $500,000, and they're saying, I got my approvals, now it's worth $1 million. When it comes down to the budget and we're using those numbers in there, do you guys have a time frame as to how long they had to have owned it for? Is there a certain amount of increase that you guys allow? Maybe just kind of speak to how much of that equity you allow and kind of how you guys view that.
Yeah, so in terms of land equity, look, if somebody's, we get this all the time. Somebody's bought a parcel for $500,000. They're like, I got a great deal. I got a great deal on it. It's worth $1 million. Yeah. We generally don't
want 80% of $1 million.
Yeah. Yeah.
Yeah. I don't have to put anything in my project now, right? It's worth $1 million.
Yeah. Generally don't buy into that. But look, if you bought this, parcel for $500,000, you went through the municipal zoning process. It took you a year and a half to do that. You upzoned it so that, maybe it was permitted for 4 units. Now it's permitted for 12. Then we can start to recognize some value if there's been an increase in the number of permissible units or the developable value of the land. So generally what we do for land values, we'll work it backwards, just a land residual calculation, they call it. So how it works is you take the end value of the completed project, you deduct your cost to build it, and you deduct a profit margin, and what you're left with is your land value at the end of it. Mm. So that's how we generally get to the land equity.
Yeah. Gotcha, that makes sense. Okay. Yeah.
So it's just math.
Yeah. And you guys are obviously too, I think it's important for borrowers to note that when we're talking about equity injection into the projects as well, it's not just from the time of financing, it's an accumulation of when they first bought the project till they get actually to the point of shovels, or I guess until they get to the point of actually financing the project with you guys, right? So your soft costs, your approvals, your acquisition fees, any of the work that you actually put into making the land usable, environmentals, remediation, all that stuff goes into your equity injection as part of the project. It's a cumulative balance, right? You're not just looking at, okay, we're in construction mode now. Now you need to bring into a new fresh 20%. You guys are taking into account all those costs.
Yeah, we'll take into account the soft cost that it took you to get to the building permit stage. But look, if you've had the land for 10 years, you've been paying interest on it. Interest, that's not a cost that we're going to recognize, right?
How far would you go back? 5 years?
We'll recognize actual costs that were spent on, say, consultants or development charges that are improving the value of the land, but sunk costs, no.
Yeah. We're also seeing an interesting trend right now where people are buying or building two or three side by side projects. I know Aaron touched on it previously. Those mid-sized development projects, a lot of people are wondering, well, how do I qualify for that? I know you spoke about like, if you don't have qualification, you want to have a good GC and stuff, but like from a net worth perspective, like what are you guys looking at? Are you looking at just obviously exit works? He's got enough money to do the project. Looks like he, shoe fits. He's got a heartbeat. He's got a credit score, like things. Like, well, what are you guys looking at?
Well, generally at a minimum, I think we want to see 1-to-1 net worth,
Okay.
exclusive of the subject property. So, we don't want somebody that's got a net worth of 100 grand taking on a $10 million project.
I've seen that application once or
You just heard
twice.
a lot of dreams out there.
Yeah, like construction is tough. I mean, I don't think it's for the faint-hearted. There's a lot of cost overruns that can come up mid-construction. And as the builder, you're responsible for any cost overruns. Like you've got to inject equity. You've got to have sufficient cash flow and be able to manage your cash flow between draws. Like we talked about, if you're going with CMHC, the draws are going to be a lot longer. But even with a private lender, you still need time to submit all your documents to the quantity surveyor. For anyone that doesn't know, a quantity surveyor just they work on behalf of a lender to ensure that the costs that the builder is saying have been spent have actually been spent. So they'll check invoices and do a site visit to make sure that work's done, and then send a report over to the lender to submit for a draw that would go to the builder. But yeah, there's like you do need a sufficient level of liquidity and net worth to support the project that you're trying to take on.
Some would say the most. I mean, construction is probably one of the most capital intensive ways to invest that you could possibly have. Now, obviously, advantages of it, landlord tenant rules, we're no longer limited to having restrictions around increasing rents. And a lot of investors right now are moving towards specifically building new inventory because of the challenges with the LTB in Ontario recently. And, it's an interesting shift because the guys who are deploying capital into the multifamily space are, I think, starting to catch on and look more deeply into building the actual assets instead of increasing the efficiencies of pre-existing ones.
Right. Yeah, and I think that's a lot of that was kicked off by the changes where so after 2018, by the the provincial government regarding rentals and rent caps, right?
Absolutely.
So we didn't build rentals in Ontario for God knows how long.
It's the 70s.
Yeah, exactly.
Yeah, everybody wanted a condo.
Yeah.
Numbers worked. Developers loved it. They were making lots of money. It's an interesting thing to see in the market.
And I think, like going back to the liquidity, it's funny when you have that conversation with a client and, they bring you a budget. Well, how much, we tell them, hey, look, realistically, it's not about like how much do I need just to scrape by. It's like, how do you portray yourself as a strong borrower, right? I mean, you take a step back even further, you take a look at, the construction development world right now. How many projects of major developers with huge reputations are in receivership right now? And there's more than what the banks would like at this point. And, you got to take a look at that trickle down effect. If you got, a $1 billion family that's having a receivership issue with one of their projects, you as a brand new investor into the development space is building your first project ever, that's just bringing 10% to the table on your 90% loan of cost. Like, are you really doing everything that you can to be able to entice a bank to want to work with you, right? And I know where we typically say, hey, as a safe benchmark, even if you get 95% loan of cost, you should still have 20% of your budget, right? If you're going direct construction financing with CMHC and it's going to take, 2-3 weeks to be able to get your cost reimbursed, well, you want to keep your guys on your site. So having that money to be able to put that out of pocket and just say, hey, like I'll pay your invoice now, I'm going to get reimbursed anyways, just to be able to keep that project moving along is, again, you're saving your interest. You're, hopefully getting into cheaper interest rates because you're getting the project done and you're just keeping your guys, on the site. So again, like it's understanding from a lender's perspective that, like the reason why there aren't as many CMHC lenders doing these sub 5 million, sub 10 million. A part of it, yes, understanding how the bond market works and pooling the funds and having capital available, but also there's risk associated with having a smaller construction loan, right? Depending on obviously, the experience of the borrower, but on average, someone doing a $2 million, $3 million build is probably a riskier borrowing client than someone doing, on a 10 million or above type project, just given how much capital they need to have, the net worth and the experience there to be able to get them to that project size.
Yeah, for sure. Well, it's cash flow is key.
Yeah.
You really need to set aside enough to keep the project moving, and also set aside enough that, if you run into any unanticipated issues like cost overruns, like to be able to cover those. So yeah, you don't want to go to the lender and just scrape by, like you said, and get your approval and get funded, and then 1 month into the project, like you have no money left in the bank, and
It's about to get dicey.
yeah. Well, it's exactly, yeah.
Everyone's going to know that first
Gasping for air, right?
Yeah.
All the time.
Yeah, what do you mean 10% holdback? What is that?
Yeah, you can't get money for another 3 weeks. Like,
Yeah.
I got to get my. It's like, well, put some of your own capital in there, pay half the bill. Get, like being able to be able to do that. Like
some new builders don't realize, like, we don't fund HST. You have to claim that back from the government, right? So they'll submit invoices, and we're only going to fund the actual amount of the invoice, not excluding HST. And the HST is their responsibility, because they'll pay it to their trades, but they'll be able to claim it back from the government. And they got to get their accountant or whoever it is to submit for that.
I guess word on the street is you can do that monthly now, or you can do it throughout the project. Yeah, so you can get it back pretty quickly as long as you're on top of it.
Yeah, but like these are things that a new builder would run into, right? If they haven't built something before, and they're going to be strapped for cash. Like you said, 10% holdbacks.
Yeah, 13% HST, 10% holdback.
The cost of the draws.
Yep. Yeah.
There's lawyer fees. There's every single time you do a draw, there's some sort of transactional cost to be able to just facilitate that financing.
Yeah, because lenders have to run title searches, property tax searches, like writ searches every time you do a draw. So those fees add up as well.
All right, last question before we let you go. If you had a crystal ball and you know what you know now, and you obviously boots on the ground, finger on the pulse of what's going on, where do you see a mid-sized construction going in the next 12 months?
Mid-sized construction. I think there's a huge market for it, because especially in these smaller municipalities where we're working, we see that a lot of the rental stock there, it's very old. Either you've got newer basement stuff, like basements that have been renovated, so there's only basements, or there's rental apartment buildings that are like 50 years old. But there's a huge shortage of newer rental stock in smaller municipalities. And honestly, the rents you get there they're not Toronto rents, but they're not too far off. Like for a 2-bed, you might be paying like $2,100 or something in these smaller markets, and it's much easier to make it work. Even from a timing perspective, to get your approvals, like working with smaller municipalities that are hungry for these rental developments, you're able to get your approvals. There's a lot of people looking for rentals there, like newer rentals that are clean. So I think that's where the market is headed. Like these small and mid-size multifamily developments. I think they're going to continue to be strong investments for the future.
Absolutely great things that echoes the trends of where a lot of our mid-sized developers and investors are moving. Secondary markets, 20, 30 minutes outside of a major area, the Woodstocks, the St. Thomases, the places that have growth coming to them. But as you said, the stock for new rental units just aren't there, but the industry is asking for it because they're bringing more people with high-paying jobs into those areas. So, all the guys who bought the GTA, you probably all made enough money anyways. You're probably okay. But like the mid-sized investors, developers are most definitely taking on the opportunity in those secondary markets.
Yeah, for sure.
Yeah. Well, appreciate you coming in today, chatting with us about construction financing. If people do want to get a hold of us and have a conversation with us about getting in contact with some mid-sized construction lenders, our contact information will be down below. If you guys have any questions about this, feel free to reach out. We're happy to answer any questions you might have. Until next time, we'll see you guys later.